This is Mongolian Mindset, and today we're going to be responding to E. Kevin. He asked us to get into investing. So this is a little rant by us on the investing side of things. We're going to keep it relatively simple. We won't be going into anything like crazy calculations, like intrinsic value calculation, so you can figure out the actual worth of a stock long term and the price point that you want to go into it. It's going to be relatively simple. We'll keep it very friendly. We won't go in too much detail like PE and stuff like that and book value, stuff like we won't go into that. Just keep it really simple for the beginners here. We have Ali, the INTP, and we have Christian, the neighborhood ISTP. Kind of weird, but whatever. Um, we all have two. Well, me and Christian kind of have the same investing philosophy, but we have the turtle INTP up there with
The farmer.
a rice farmer mentality. But let me say something. He's kicking our ass right now. You got lucky. You got fucking lucky with all these goddamn wars and shit. But yeah. We'll get into it. But go ahead, Ollie. What you got to say? Huh?
I didn't get lucky. This was exactly, you knew exactly what this outcome was going to be, that I was just going to like slowly, steadily. Anyways, whatever.
Fuck you.
So true. It's just
Um,
right now he got us on a downturn, so he kicking our ass pretty bad.
he kicking
But
it pretty
we
bad. Like
but we gonna
kicking it
catch
so
up. Don't you
bad that
worry.
I don't
We
know if
gonna
I can
catch up.
stomach this
There's
shit. Um,
there's a 1 in 20 chance that you will beat me. I will say that. Yes.
120.
one in 20.
Because not, oh, whatever, we can get in. Do you
Go,
want
go,
me
go,
to,
go for it. Go
whatever.
Not
for
yet,
it.
not yet, not yet. Hold on. Before we start,
Okay.
just for the intro. Before you watch this video, go watch the first finance video we dropped on Mercer's channel. Because that was like the bare basics. Like before you even get into investing, you need to make sure you got that straight. Once you got that, then you move on to this one, and then you'll be on a good trajectory.
Yeah.
Okay. So
Me and Christian have been investing in the stock market since what, 2016, 2016, 2017, 2016. One of
2016, 2017, that's when we started. Yeah.
yeah. So we're pretty versed in investing. So I guess we'll go ahead and start. I mean, the first thing you have to do is you have to open a brokerage account. But the first thing you want to make sure you have, I'm a little bit risk averse versus Christian. You need to have at least 6 months to a year savings before you start investing. Christian, on the other hand, he likes to be a little bit more risky. He'll do 3 months.
Three,
Three
3 months.
months.
Wait, yeah, we touched that in the last video. It's like
Mhm.
everybody's risk tolerance is different. Some people need 6 months, some people need 3 months for an emergency fund. But remember, like that varies too. Like it goes up and down as especially with jobs like ours that kind of like go up and down with the seasons. You know.
So a big thing that you want to always, the reason why you want to have the savings is from a psychological aspect. If you have the money in your savings, then you're not worried about what's going on in the market because nobody can predict the market in the short term, but in the long term it goes up and has been shown to go up. So you want to have that money in there just in case something does happen. You don't have to sell your stocks or whatever. Maybe you take a loss or something like that, or you have more of a detached um, emotions to the stocks that you're buying. Okay, because they will fluctuate. It's pretty much people's popular opinion at the moment. A lot of times, but over time, it is backed by increase. Shit, what was the fucking word for it? Over time, the stock
But the
production goes up over because of
increase of the economy. So the increase of the
not
economy
economy, but
and yeah, companies continue to innovate and produce more.
yeah,
And as you
production goes
share
up.
their profits, your stocks will go up. That's
Mhm.
essentially how stocks
So they have the
work. Some companies will give you a dividend, cash value, or some you just sharing their appreciation,
Yeah. So basically,
depending on
what ends up going on is stocks appreciate due to the earnings. They have earnings every 3 months. So they come out basically, and the CEO basically says how much they sold, how much they did sell, how much inventory they got, how much profit they made, what's the EBITDA, things like that. They do that every 3 months. A lot of times, if you have a dividend stock, they will be giving out dividends around that time as well. They have a dividend period when they pay you back. But generally speaking, the higher the dividend, the less growth the stock's gonna have. So a lot of times people will go into stocks that have a high growth. You probably won't get a dividend. But if you got like the older blue chip stocks, the aristocrat stocks, They tend to give dividends. And depending on like what you want to invest in, some people are growth investors, some people are dividend investors. Um, whatever you decide to do, that's up to you.
Mhm. But let's go ahead and start with how or what brokerages they can open so they can get started, and then we'll start detailing what the different accounts are that they could put their money into, because there are different ones that have different benefits as opposed to others. So go ahead, Mercer, if you want to start with the brokerages.
I'm gonna say, Ali, you got anything you want to say before we start that?
I mean, I was just gonna give my whole like simple strategy like in one go. I was gonna wait for you guys to finish and then say what I have to say.
Okay, well,
Yeah.
let me go ahead and share screen here.
Mm-hmm.
So we have the brokerages here. You have to open a brokerage to be able to buy stocks. Like that be Vanguard is one. Vanguard is a brokerage as well. Um, I guess is this one Christian SoFi? Is that what you
SoFi is a bank, and we'll get to that. But SoFi is a bank that has a high yield savings account that gives you 4.6%. It's not exactly investing in stocks, but it does give you appreciation, guaranteed 4.6% without essentially any risk, because it's just a savings account. So I just wanted to add that in, because a lot of
retail?
people, maybe they don't have their emergency fund there yet, but it could be beneficial to start your emergency fund in a company like this that offers 4.6%, as opposed to starting it in your traditional bank that probably gives you 0.000 whatever percent. That's nothing essentially.
Yeah, yeah,
So
yeah.
yeah.
You gotta remember that like the bank gives you a shitty ass percent, but then they loan money out to other people and make a fucking killing. Okay, so fuck them. Put your money somewhere where you can get more money for it. Then you have Robinhood. Okay, that's kind of the one that like a lot of beginners use was
Yeah.
Robinhood, but they've slowly become actually pretty fucking good. You won't notice any differences between them or like the bigger ones now. But when they had first started, they were the ones who actually changed the whole market. Before that, you had to pay a certain amount of money to do trades. But
Mhm.
Robinhood was the first pioneer that said we're not going to charge people for trades, and everybody jumped into Robinhood, and then all the other brokerages had to follow. I remember
Yeah.
at
So
that point in time, I was paying like $2 per trade or something like that from Charles Schwab. Uh, Christian was a Robinhood loser.
I can speak to that, because I still use Robinhood to this day, so I can
I have
kind
it
of
too. I
talk
have it
about.
for crypto stuff.
Yeah, so Robinhood has evolved from the trading platform that they used to be. It used to be more about getting beginners in and getting them trading
Mm-hmm.
stocks and whatever, but
So much.
uh they've added actual retirement accounts to Robinhood. And right now I have my Roth IRA open with Robinhood because they offer
The highest.
3%. They offer 3% back on your money, similar to how your employer would give you 3% or 4% back on your money. So essentially, you could have your 401k running, getting 100% returns on the cash back guarantee from your employer, and you could have a Roth IRA with Robinhood also giving you 3% guaranteed, which is essentially 100% on that 3%
Yeah.
guaranteed as well. So you can
So
have both.
what I'll
And
say, what I'll
previously
say,
you couldn't get that for example, on a Vanguard or
yeah.
that type of company. So
The Robinhood is very innovative, and their goal is to basically push the market. Like they're always going to be pushing it. They're always going to be coming up with things to benefit people, to make people want to be there. So if that sounds like you go ahead and get them. I love them. I use them for my crypto type stuff. It's very easy for me. And they're free, so it's pretty
now,
self-explanatory.
one warning that I want to give with Robinhood, because they're so appealing to the eye and they kind of made a easy to use platform, it might be easier for you to get into stuff like margin trading and stuff like that. Now, if you don't have discipline to stay away from those things as a beginning investor, then maybe Robinhood is not for you, because we don't want to kind of recommend platforms that are going to get you into some sort of risky investment that will lose you money, like essentially, from the start, so just be careful when you go to Robinhood. Stay with the basics, open retirement accounts, and maybe even buy some single stocks. Just stay away from the margin investing and
Mhm.
that kind of thing.
And
Just saying.
disclaimer here, we are not a financial analyst or anything like that. We'll just
Yeah.
give you our opinion of things and what we've done from our personal experience.
Yeah, and we're not gonna recommend stocks and investments. We're just gonna educate you on the accounts and the platforms, and then you make your own decisions.
Yeah.
Okay.
So that's them. Like I said, very innovative. Always gonna be pushing the market here. Um, and then you have like the more traditional things like TD Ameritrade. It's pretty much they're owned by Charles Schwab now. I forgot about that. Charles Schwab did buy them. But these are more your traditional things. I have a Charles Schwab account. That's where the bulk of my money is. Um, that's pretty much it. I mean, you just basically they ask you for your tax information and things like that, and you put in the information, and then they allow you to trade.
Also, one that you're missing is Fidelity. I think a lot of people
Yeah, Fidelity.
probably have Fidelity through their employer because
Yeah,
they're a pretty common one that they use. So, if you already have a Fidelity account with your employer, you could actually open up other accounts with the same account, which I helped my fiance do not too long ago. She has her 403b with Fidelity and open a Roth for her as well. So it could be easy to use the same platform that you're already utilizing through your employer. So just keep that in mind.
yeah. So I mean, those are the ways that you start. Depends on what you want to do after that. Some people take a more active approach, which me and Christian have done. We have a problem with thinking we're the smartest person in every room. Come back to bite you sometimes. But you can take a more active role, like buying your own individual stocks, or you could take a more of a passive role, which is kind of in between by buying ETFs, or you could take a straight up passive role and have mutual funds where you have X amount of money come straight out of your bank account, and then whatever the mutual fund, they do all the investing for you. Okay. But there's like levels to it. And me and Christian, we're bold motherfuckers. So we wanted to buy stocks for ourselves. As in the INTP up there, he's a cuckold. I'm kidding. He did it you know how they go. They go for the best possible outcome. That's generally what Ali went for. He's not Ali, go ahead and give him your breakdown.
Okay, sure. So
Well, first tell them like where you are in your investing journey or like what you've been able to achieve with your strategy, which is pretty impressive. So you go ahead and let them know.
okay, sure. I actually do not give a fuck about stocks. I don't want to think about them at all. I don't want to consume any amount of my headspace. So I went for what is it? I was kind of scared of like going into the stock market. I'm like, oh, what if I lose all my money? That kind of stuff. And then when I found out about index funds, took me a while to finally just get into it. I was only focused on paying off my debts, like my student loans, and killing those off. And then I kind of just let money sit in my bank account. And then I realized, wait, inflation is gonna, kill this thing. It's gonna make the money in my bank account go to shit, basically. I did the math. The average inflation is 3% a year, which means that if you just let your money sit from today and just, let it sit there, 23 years later, the value gets cut in half. So if you don't take a risk in the stock market, like you might be like, okay, if I go and risk in the stock market, I might get fucked. If you leave your money in a bank account, you're guaranteed to get fucked. So it's like you really should put money in the stock market. And then one of my coworkers told me about index funds and investing in 401ks and IRAs and tax advantage accounts. And since 2018, I think, is when I finally started investing. And yeah, I'm pretty well off. I think if I were to not put in any more money now, I'd probably end up becoming a millionaire by the time I retire. And that's my objective, by the way. I'm just trying to make it so that I have some form of retirement as opposed to trying to get rich quickly. It's a very long-term strategy as opposed to, hey, let me see how I can make money as fast as possible. So does that enough background?
Yeah, that's
Yeah,
perfect.
and let's be honest, like your objective is not to get rich quickly, but you've built up a very substantial amount of money in a short amount of
Yeah.
time. I mean, yeah, the market helped, in certain ways, but just the fact that you were able to invest that money and actually were proactive about it is what got you there, right?
Yeah, it's kind of like working out, right? It's just consistency. So, I mean, if you take half your paycheck and dump it every paycheck into index funds and, you know, like 5 years later, yeah, you have a stupid amount of money accumulated.
Right. Now, can you talk about your kind of like your saving strategy? Like, um do you consider yourself like a minimalist in the middle, or do you spend a lot of money, or what do you do?
What is it? I used to be a minimalist. I can't call myself a minimalist anymore. No, I definitely can't. Yeah, I'm spending about every paycheck I get, let's just say it's $100, just to make the math really simple. 50 of those dollars are gonna go into index funds. And then like 25 of the 24 of those dollars goes to taxes, and then the other $26 I just burn on whatever. That's pretty much what I do. And I have a 6 month nest egg saved up and zero debt. So um
Oh, mhm.
I was gonna just give general like advice to people, like a strategy for how they can like
Mhm.
if they
So
want to
can
do what I
you
do.
so you mentioned index funds. Can you kind of define for the audience what an index fund is, and what made you choose an index fund as opposed to single stocks?
Okay, so let's say okay. So an index fund is a specific type of mutual fund. You know what? I'm not even gonna use the word mutual fund. Like an index, even though that's what it is. An index fund, okay, so the one that I use, the one that got popularized in the book, The Simple Path to Wealth, which is kind of like a guide to anyone for investing the way that I am. An index fund, like VTSAX, for example, is composed of 3,600 individual stocks. And the percentage of each stock in that index fund reflects how large of a company that how large of a company that is relative to the other like 3,599. So like VTSAX is composed of Apple, Google, Microsoft, like all the 3,600 biggest companies in America, but Apple is literally 5% of it because Apple is $1 trillion company.
More than a
So
trillion, like 3 trillion.
yeah,
Yeah, like over a
so
trillion. Hmm.
yeah, so an index fund is going to be it's an index. It's a reflection of the VTSAX is for America. So VTSAX is an index of the American economy. It's the top 3,600 companies with a percentage for each company based on how large a company is. And over the course of time, as companies rise and as other companies die off, the composition of that index fund will change. So it's like self-cleansing, and it's something that's almost it's basically an algorithm. It
It's an
doesn't
algorithm. Yeah.
require. Huh?
Yeah, so it's an algorithm. Yeah, I was about
It's
to say that. Yeah.
basically
Continue,
if you
continue.
want to think about it, it's just like if you simplistically, it's like humans, animals as one creature dies, another one takes its place. That's essentially what happens here. As one company fucking goes bankrupt, another one takes its fucking place.
Yeah, and
Yeah,
not even bankrupt, because remember it's choosing from the best companies in the U.S.
Same
markets.
thing.
So as one replaces another, it'll fall off the list and it'll be replaced by another. So it's essentially a computer picking the best stocks for you, all like blue chip stocks, and $1 gets diversified amongst all of the companies that are within the basket, right? Just
yeah.
just to make it simple for people, so they understand what it is. So essentially, you're instantly diversifying your dollar when you put your money into an index fund.
So
Yeah, exactly.
what that means is that like you're a lot safer than individual stocks. Okay. This is no brain, like no brain here. You need no brain activity up top to do this.
Yeah,
Exactly.
yeah,
Exactly. Yeah. Because like if you pick individual stocks, you're constantly worried about like what percentage of each company makes up your portfolio. This is brain dead. It's literally 3,600 something companies
mhm.
with your money evenly distributed amongst them based on how big they are. And the thing is, the guy, what is it? John Bogle, the man who invented index funds, and he did I forgot how many decades his research went, but like he over a long period of time, he compared the performance of like if you just put your money brain dead into an index fund versus actively managed funds where you had like actual human beings trying to figure out like okay, this is a company to invest into. Like
Mhm.
who had college degrees in this stuff, who spent their 8 hour days working on just trying to, beat whatever the index average was. And what John Bogle's research showed was that 95% of those actively managed mutual funds could not beat the brain dead average index.
Mm-hmm.
And it might have been even 97%. But
So,
anyways,
would you say that your knowledge of actual stock, like single stock investing, is very small, but you've been able to use index funds to instantly put yourself in a good position within the market and actually invest without having to, like you said, spend 8 hours a day studying the markets and so forth.
yes, that's exactly right. But it goes a little bit more beyond that, which is that I don't think it's possible to predict the market. That's the thing I was trying to get at. The 5% of people who beat the market, like the 3 to
Peter Lynch,
5% of people
Peter Lynch's, the Warren Buffett's, those guys.
those guys are really exceptional outliers, but for the most part, that, for the most part, when it comes to people who had funds that beat the market, most of the time they were actually losing money compared to the index funds. And then the reason they overall beat the market is because they had like a few lucky bets. Like maybe someone bet on Google really early on, but then the rest of the time, like their bets weren't as good as the market average. And again, these are people spending an actual their jobs were to go and beat the index funds. And I think that just goes to show you can't predict the market. So if you're just going in it for the long run, an index fund, a brain dead index fund, you're just like, all right, let me just throw my money at this. I don't care if we're in a recession. I don't care what's going on. In the long run, you're going to beat 95% of the active investors without even really trying. And
So, so
what else?
what would you tell someone who's like, okay, that sounds good, but I'm just like, I'm afraid that I'm gonna lose my money. Like, what would you tell
I
somebody?
I 100% feel you. That's why even after I learned about this for 1 year, I didn't do anything. So in that case, you look at stuff that comes out like, oh, Bitcoin, it looks like promising, and then you invest in it, you lose all your fucking money. It's like if you go ahead and like invest in new things, that's inherently risky because it doesn't have the track record. I mean, if you're worried about investing and losing your money, I recommend picking up The Simple Path to Wealth. It's a book by like a guy who is used the index fund strategy. And it's explaining how, okay, VTSAX, a low expense ratio index fund, has been around for decades, and people have literally early retired on it. So, I mean, if you're worried about losing your money, I totally get you. I totally get you. Like these financial institutions, I do not trust them for shit. So they literally have to have decades of track record for me to even consider trusting them. So I recommend if you feel like you can't trust them because you're scared of like lack of knowledge and stuff, get yourself educated, grab that book, The Simple Path to Wealth. If you want, there's also another book by John Bogle himself who invented index funds, The Little Book of Common Sense Investing. Like educate yourself on it.
Yeah,
And then once you
Benjamin Graham's book. Just overall, I mean, you gotta get the knowledge. Benjamin Graham, the intelligent investor, he was Warren Buffett's teacher, but that's more like stock picking and stuff. But like overall, you generally want to have a general knowledge of everything. That's gonna just help you. But
Another thing I like to tell people too that may be nervous about investing, I'll say that you are probably already investing and you don't even realize. Like if you go into your 401k at your job and you open up the actual investment tab, it'll show what the people are investing into. And a lot of it, a big percentage of it is the index funds that Ali is talking about. So it's like even the professionals are doing it because they can't beat the market. So like a large percentage of it will be index funds just so that they can have that buffer. They'll try to beat it, but a lot of the times they even can't. So it's like what Ali's saying is correct. This is like as a general rule of thumb, I think everyone should start with index funds. You shouldn't do what we did and like actually start with single stocks and stuff like that.
mhm.
So
Oh yeah, that's another thing I wanted to touch on. So I think one of the things that confused me early on, I was like, what's an index fund and what's a 401k and what are the relationships between the two? So there's a concept of an account and there's a concept of the actual stocks themselves. So the index funds is just a collection of stocks basically, but you don't put money directly. How do I put this? Like you put your money into an account. You put your money into either a 401k or an IRA or a brokerage account. These are all accounts. But what stocks are these accounts made of? That's something that you pick. So I would just go ahead and pick for your brokerage account and for your IRA, you can pick whatever you want. So I picked VTSAX for both of them. And for my 401ks, whatever your company offers you. So I got like the S&P 500. It's another index fund of like the top 500 companies in America. So that's
Yeah.
the relationship between a mutual fund or an index fund versus an account. You put money into an account, but the account itself is, funneling money into, stocks, index funds, mutual funds, stocks. Yeah.
Okay. Let me try to kind of simplify what you just said, just like in a short amount and short words, right? It's like there's the account where you put your money in, and within that account, you can buy stocks, and index funds are part of those stocks. That's it. Like that simple. Essentially, like think of it like you have your bank account and you put your money in, but then it subdivides in between checkings and savings. Like let's say you can put your money into actual brokerage and not be invested, just so people know. Like it's not enough to just put the money in, because some people do that. They realize like 10 years later they never invested. They just put their money into an account, a brokerage account, and never actually picked an investment.
Then you got to
I've
go
heard,
to the ticker symbol. You have to go in the symbols, like he says, VTX.
yeah,
The one that follows the S&P 500 is VU. It's
VO,
Vanguard.
the
But
Vanguard.
then depending on whichever ETF you like, maybe you want to pick, because they have different ETFs depending on what you're looking for. Um, like let's say, for instance, you were betting on AI. Okay, there's an AI ETF. It might have a different expense ratio. It might be a little bit more expensive. But there's different ETFs depending on what you want to do. Ali's just talking about the safest one. Okay, that's basically the biggest companies in the world. The
That's
world.
BT, right? BT is the safest one. It's the world index. Is that what you're investing into, or the S&P 500?
Me?
Yeah,
Yeah,
Me?
you.
I think it's
Yeah.
world.
VTSAX is actually it's just in America, the top
Yeah,
3,600 something just in America.
Okay. Top
Yeah.
3,000. The
that's
S&P
super risk
500 would
averse.
be top 500, right?
Yeah. Yeah.
Okay. Okay.
So
Okay.
he's super risk averse with that. That's a little too
Yeah.
slow
Yeah.
for me. That's a little way too slow. If I was gonna put anything, I'd buy S&P 500.
S&P,
I
yeah.
don't need the 32 other 100 companies because that's just junk. I don't want the junk. And
Honestly,
that's
they
me and Christian's
track.
mindset all the time as well. It's like the reason why we went individually stock is because we don't want the junk. We want the Apples, the Googles, the Microsoft, things
The
like
best
that. The
the
thing
best vehicle. The
Yeah,
best
best
vehicle.
vehicle to get you to where you want to go. But the thing is,
Honest,
you have to be reading the earnings reports and things like that, and you have to stay current with your stock. Like for instance, not a couple years ago, Jeff Bezos stepped down from Amazon. Okay, you got to understand where the fuck that's going to go for you and your stock. Okay, Charlie Munger just died. Okay, if you're in Berkshire Hathaway, how's that going to affect your stock? Because people fluctuate money off a lot of times just opinion, just
Mhm.
fucking opinion. Like the stock could be doing fucking phenomenal, and people decide to pull the fucking money. Okay,
Yeah.
so you
But to,
gotta.
but to Ali's point, most people wouldn't want to worry about those things or put in the work to do that. Now, like we said, there's like tiers to how much you want to be involved. I think buying index fund is a nice middle ground. I tend to always go for the middle ground option in everything because it has the best value. This is kind of like that. Like you get the best value for the lowest amount of work at index funds. Now you could put it in a mutual fund and just let somebody manage it completely, but just know that you're paying that person. Like it's not free, you know.
A
yeah,
certain
you can
percentage. I
just
think some of them are again. I'm not exactly sure, but they're getting relatively cheaper. As opposed to because open competition drives down the market for a lot of it. But that is you just tell them straight up, I want $500 coming from my paycheck into this mutual fund, and then somebody else manages the money and they pick the stocks they want you to have in the mutual in the index or whatever the hell they want you to. Okay. And you could
Not
probably select a different type of mutual fund that you want. Uh,
mhm. Yeah.
so
Can we talk about the kinds of accounts that are available now that Ali kind of detailed that the index funds are within accounts and they can be different. So what are the different accounts that are available, Mercer, if you want to start?
Okay, so I mean, you have your brokerage. That's going to be where you buy your stocks at. Um, the tax situation is a lot different there. You have your short-term tax and your long-term tax. Any stock held over a year is qualifies for long-term. So then you get taxed a lot lower. But if you are doing short-term, anything within a year, then you get slapped at capital gains. Okay. Um, so you got to understand that. And that's in your brokerage account. You basically open that. They run your background and your stuff, make sure like all that kind of crap. And then you could go in there, you deposit money in there, and then you go and like, okay, I'm gonna buy Meta. That's Facebook. That's also Instagram or whatever. And you type in the ticker symbol META and Meta will pop up. And then you can say how much money you want to buy in Meta stock. And now that becomes part of your brokerage. If
Mhm.
you want to buy an ETF like VOO or BUG, the growth one, you would type that in and then you would go and purchase how many shares you want. A lot of times now they're doing fractional shares. A lot of companies are doing fractional shares, which helps a lot. So you don't have to have the exact dollar amount. That helps
Mhm.
so much because like some stocks, like back in the day when I used to buy Amazon, I used to have to save like like a fucking month to buy Amazon stock because it was like $2,000 a share. But with fractional shares, it allows you to buy that stock with fractions now. But they've split now, so it's a lot cheaper to buy in Amazon. But back in the day, was before they ever split. So you have your fractional shares with that, and you just buy and then slowly increase as you go. Um, and then you have your traditional Roth. That's kind of a retirement account. It is taxed differently. That is more of a
Traditional IRA. Traditional IRA.
traditional IRA.
Yeah. Yeah.
Traditional RA, and that's taxed a little bit differently. So they allow you to write that off for the amount of money that you put in there this year. They allow you to write that off to a certain amount. But when you pull that money out, you're gonna be taxed on it. Okay. So I think I'm not exactly sure how much money you could put in there a year. I think it's over 20 some thousand or something like that. I want to say you could put in there a year. It might be more. I forget exactly how much you could put in there. But they have a cap on how much money you can put in there. But like I said, the main thing you want to realize is that you're not taxed on it now, but when you pull that money out later on in life, that's when they're gonna hit your ass across the head. Okay.
Yeah. And the way that works would be obviously when you get your money, it's already comes taxed because
Mhm.
your employer will take taxes out. But then when you put the money into the IRA, when you file your taxes at the end of the year, you get to report that income and you get a tax break on that money. You get your taxes back on the money that you put in. But like Mercer said, when you take it out at retirement, they're gonna take the taxes out of the money you put in and the appreciation. Now, there's an alternative to that. If you really need the tax break now, it's probably because you make a lot of money and you want the tax break now. But for most people, especially if you're young, it would be beneficial to put it into a Roth IRA
Which is
instead.
another one.
Yeah, which is a different one. And
Different.
so I'll detail the Roth IRA for you guys. The Roth IRA is an account similar to the IRA, but you put money in that's already taxed. When you put the money that's already taxed, you don't get a tax break on it. You're telling the government, okay, I pay tax on this money. I'm going to put it forth towards retirement and I don't want a tax break on it. Now, the deal is whatever appreciation I get on that money from then until I retire, when I take it out, will be tax free. So it's very powerful because if you put it in early enough, let's say $10,000 could turn into hundreds of thousands or even a million, right? By the time of retirement, and you get to take that money out tax free. That's why I always say most people should be putting money into a Roth, especially if you're
All right.
under the age of like 45 or 40 or whatever.
But then you also have to let them know that, see, the traditional Roth, you're allowed to put more money into it. With the Roth IRA, there's a certain amount of money that you can put in there every year. And it slowly goes up. Now it's at what, 6,500 per year
Yeah, they,
and
they upped it to 7,000
7,000. So
this year.
they up it slowly. I remember when I first started, it was only like 5,200 or something when me and Nemo first.
Yeah, but keep in mind, the reason they limit it is because it's such a powerful tool. If it wasn't that powerful, they wouldn't limit it to that extent. So everybody should go on Google right now and just verify what I'm saying and learn about Roth IRAs because it could change your life, especially because, like I said, the appreciation will be way higher than the money you actually invested initially, and you get to take that tax free. That's incredibly powerful.
And there's other like little technicalities of like if you needed to pull the money out early or whatever, because there's a certain age like you can't pull the money out on. I forget exactly the certain age you can't like touch the money for. But then there's
Another, yeah,
other like
another thing I want to
technicalities.
add, something I want to add. The money you put in, you could actually take out penalty free. The initial investment, not the appreciation. That's another powerful tool because let's say I want to save. I mean, I don't recommend this. You should never pull from your retirement, but there are people who want to diversify into other investments later in life. And let's say you started with the Roth IRA and you've been investing in it for like 10 years and it appreciated a large amount. And let's say you wanted to buy a house and you could pull the initial investment out as a down payment on the house and you still keep the appreciation growing tax free. So basically, it's like you could save money, get tax free appreciation, and then use that money later on if you choose. Now, I
I
don't
think
recommend that. I don't recommend that
I
because
forget
you
the
should pull it later.
technicalities behind it, but I think also if you like going to school or anything, like any like major things, just look at the technicalities of like when you can pull it out. But there are exceptions to the rules of when you can pull it out. But generally speaking, they have a certain age where they allow you to pull it out. I think it's like 59 or some shit. I can't or 50. I forget exactly what it is.
Yeah, but the Roth IRA, the appreciation you could pull at 50 something, but
Yeah.
you could pull the initial investment whenever you want, penalty free. Yeah, that's why it's pretty versatile retirement account and very powerful because of the tax free appreciation. Now, Ali, do you have any? We talked about Roth IRAs. Like initially, you weren't investing in a Roth IRA, correct?
Yeah, I misunderstood about like how much. What is it? I thought like when it came to, I had a misunderstanding about it basically in a nutshell. Yeah, Roth is better.
It's really, it's
Right
really
there.
good. I mean,
Roth is better.
Christian
So have
Christian
you
did
started?
wasn't initially investing in a Roth, but me and Nima have been investing in it since 2017. I think
Well,
we've been.
my the reason I wasn't investing in a personal Roth IRA is because my retirement account at my job is a Roth IRA. I as soon as I started working and they told me I had two possible accounts, which is post tax or pre tax, I researched it and obviously I picked the Roth. Now looking back in hindsight, I would have also opened my own personal Roth and maxed that out every year before I even started investing into single stocks on my personal brokerage. Like, I mean, this is kind of, obviously hindsight's 2020, but it would have been very powerful if I would have maxed out a Roth with the index fund first, and then the remaining of my dollars went and invested in whatever I wanted, because that kind of like covers your bases, which is what I kind of wanted to end my side on. Like that's like that what I got out of it. Of course, index funds are just so powerful because they're already diversified and they're like low barrier of entry. And then the Roth itself is so powerful because of the tax free appreciation. If you combine those two, it kind of guarantees you, a good return essentially. So everyone should kind of start with that.
I mean, if especially if you were keeping that 3 months to 6 months uh salary for savings, you gotta have that. You gotta have that. And then from there you start doing this and you'll be in very good hands. Like I said, there's books you can pick up. The Intelligent Investor by Benjamin Graham, or Walk Down Wall Street by Peter Lynch. If you're into stock picking, don't recommend it for you guys because there's a lot of reading. You got to be able to read these annual reports. You got to be down into these annual reports. You got to be staying up on top of it. Um, a lot of people just can't. They ain't gonna stay up on it. They got other shit going on. They got kids. They got um, other things that they have to worry about. So for the no braining, you just get an ETF like BOO, which is Vanguard, and you can let me see, you can start buying that. and you just keep buying it, and you don't even have to worry about what's going on. I mean, I don't care. You don't have to worry if your mama die or something. It's the same shit. It does not matter at all. It's absolutely no brain.
Mhm.
See, that's it right there.
Mhm.
Uh,
Go to the max. Go to the max view. Go to the max view so I can see the appreciation over the years.
oh, you talking about the 5 year?
No, the max, the max.
Oh,
Oh, I want to add something too, by the way. You see that compare button on the top right? You can compare like different index funds to, so you can compare VOO to VTSAX or S&P 500 or whatever.
Mhm.
that's you
And
right
then you
here.
can even, and then you can even like
What is
see it
it?
over
Is
the
that it?
max lifetime.
That's not it,
Huh?
is it? That's not it, is
No,
it?
no, no.
What is it?
Uh,
What's the ticket symbol?
VTSAX.
What?
VTSAX.
Yeah,
VTSAX.
yeah,
And
all right, right
total
there.
stock market. But
Yep,
see, but
first one.
it's the total stock market. It's not just the US.
Yeah,
You're investing in the total stock market, including
I
international.
think it's just the US. But look at the max, by
I
the way.
It
mean,
says
they're pretty close. They're pretty
it's
Yeah,
close.
total
exactly.
stock market.
So yeah, I mean, you'll notice that the top 500 companies can like perform relatively the same as like the
Yeah,
top 3,600. It's not
Okay.
much of a difference. So,
not
and
much
that
of a
shows you the
difference.
percent growth. So, and that's showing you that like really these index funds are not too different. I think the most important number like that you should consider when picking an index fund is the expense ratio because
Mhm.
that's a compound interest that you pay. So VTSAX has a compound as an expense ratio of 0.04%. Now, fun fact, back in the day when people didn't really know that much about expense ratios, they would see like a 2% expense ratio and be like, oh, that doesn't sound too bad. And what they don't realize is that a
Look at my boy
2%,
there, man. Look at my boy there. The Berkshire Hathaway. You
Yeah,
see
I
that
see that.
red boy? You see what your papa told you, boy? I know you don't want to listen to me, but Papa's always right, Christian. Papa's always right. You see that?
I mean,
Mm. I still think
you,
you're
Shut up, boy.
I still
I didn't
think you're
ask you to
not taking
speak.
into account
so
the
here's why you wouldn't like necessarily want to do that, like putting all your money into Berkshire Hathaway instead of VTSAX. It's because you are betting on one company, on one. Essentially, you're having all your faith in one man, Warren Buffett, and that's a concentration of risk. So if he messes up, you go down with him. With the VTS, with like investing in the
I
top
mean, but
500 to 3,000.
Ali, I'm gonna push back on you with that because at this point, Berkshire Hathaway is basically an ETF with no expense ratio. Because of the amount of stocks they own with the railroads, the Denny's, the Apples, the Amazon. It's basically a fucking ETF at this point. But
What's
hey,
their method? What's their methodology for allocating how much
I don't fucking know,
percentage?
but I just, I mean,
bro, he doesn't have a methodology. He's saying put 100% into Berkshire.
I
I'm
just
saying, hey, you could do
I'm
both.
saying,
You could do
hey,
80.
hey, motherfucker, shut your mouth.
No, I'm just saying like there's always a middle ground. You could do 80% VOO, 20% Berkshire, and you create alpha in within that 20% of Berkshire if they outperform. Or you could create, a little
It's all
more,
up to
a little
you.
negative return
But
and
if somebody was asking me, Mercer, what is one stock you would buy, and that would be it for the rest of your life?
but I thought you weren't giving financial advice.
I'm just saying, if you ask me, boy, hey, don't interrupt me. If you ask me, one stock you buy, rest of your life, Mercer, you ain't gonna lose no sleep. You're not gonna slap Christian. You're not gonna choke him. What stock you buying? I'm buying Berkshire Hathaway. Like I said, it's essentially an ETF at this point because it's holding all these different companies: Apple, Bank of America, American Express, Coca-Cola, Chevron, Oxy, Kraft Heinz, Moody's Corp, DaVita, um, Citigroup, Kroger, Visa, Charter, Master. At this point, it is what it is. They're basically
It's steady. It's steady.
they buy things like railroads. They're very STJ oriented. They do the safe and steady shit. They know railroads ain't going nowhere. There's a high barrier of entry to be able to start a railroad company. I mean, railroad industry or whatever. It's very high barrier of entry, and that's what they take advantage of. And it does absolutely amazing. And when I get back to investing in February, that's all I'm buying. Fuck what they talking about.
So Ali,
all right.
before everyone just starts investing, what do you think are the bases they should cover first, like before they even start investing?
Okay, yeah. Avoid debt when possible. If you are swimming in debt and you're struggling to, pay off your debts, take care of that first. If you have a mortgage, that's a different story. I mean, that's kind of like rent,
Good
I
debt.
guess. I don't know.
Good debt.
So avoid debt when possible. Try to pay off your student loans, try to pay off your car loans, try to pay off stuff like that before you actually start investing. I would also make a nest egg, 3 to 6 months. And then once you decide, like, hey, I want to invest in this index fund or Berkshire Hathaway, as Mercer is going to apparently, go ahead and I would say that in terms of the accounts that you pick, if you're working in a company that gives you like, hey, we're going to give you a 6% match on your 401k, that's just free money. You might as well, at the very least, like invest in your 401k up until you get that free money. Like, there's no reason not to. And then from there, if you have money left over to invest in a Roth IRA. If you max that out and you have money left over, it's a choice for you to either max out your 401k, which is also a tax advantaged account because you don't get taxed putting money in there, or if you want to just go straight for the brokerage account. So that's what I would say.
And I have one other. It's not. I think they do invest your money. I haven't opened one yet
What?
because I'm doing other stuff. But HSA as well. You could do
Oh
a
yeah, that's
health.
right.
That's hot.
HSA.
Yeah, that's for medical stuff, ain't it?
Yeah, you could
Yeah,
do a
that's
health
actually
savings account. Health savings
yeah.
account will allow you to put money also tax advantaged for future medical investments. And I think they appreciate also over time. They invest it for you similar to like a 401k. But I have to
Yeah.
research because I don't have one currently. So I'm not
Me
up to
either.
date on that.
Yeah, HSA is stupid. You know how with like a 401k, if you don't get taxed putting money in, but you get taxed taking money out, so that you get taxed on the appreciation. With Roth, you get taxed putting money in, but you don't get taxed taking money out, so you don't get taxed on the appreciation there. With HSA, you don't get taxed putting money in, and you don't get taxed taking money out.
Yeah, because it's
If
like
you
a
have it available,
medical shit.
As long as you use it for medical purposes.
which as you get older, you're going to have medical expenses. So my
Yeah.
advice for if you have an HSA available is to put money in it. And when you have to pay for medical expenses now, actually don't take money out of your HSA because you can only put $3,600 in it per year. So max that out and then pay for medical expenses out of pocket. Let that HSA keep growing and growing and appreciating. And then you have a shit ton of money to pay for your medical expenses in the future. So
For
in terms
kids,
of medical costs, you're making it cheaper. This is assuming that you live to an old age. You might die and get hit by a bus early on, then then it's wasted. But assuming you live to an old age, it's more in your financial incentive to do that. Like,
you did an
yeah.
Yeah.
outstanding job, there, Ali. You just convinced me.
Great
You know,
advice, man.
outstanding
Honestly, I
job,
didn't
Ali.
even know that. I didn't know you could
I,
only limit it.
I knew about it, but it was just like kind of weird. And last time they like wanted me to like jump to a hula hoop to open one, I was kind of pissed about it, and they like declined me because they're like,
Mm.
with the addresses, like
Yeah.
all that shit, it fucking pissed me off. So I just said, fuck it.
Yeah.
But yeah, Ali, you made a good point there. I might
Great advice, man. Great
yeah.
advice. I didn't know you could only put 3K. That's very good point. Like let it build up. Don't even waste it if you have to do a medical expense. And we're young, so if you're
Yeah.
young building up a HSA, basically you're gonna be covered by the time
Yeah, and
you
you can take
retire.
it out for your kids and all that type of stuff.
Yeah.
Dental stuff, all that. I mean, anything medical related. It's actually pretty good. Thank you, Ali, for that. I might
Yeah, no
have
problem.
those.
Yeah,
But
man. I
guys,
think
that's
we
pretty much everything we got.
we
Um,
covered a lot.
this is
We
this is
covered
the
like
big
all of this.
this is the beginning steps to a lot of things. The things you want to take from this is make sure you have your savings depending on your risk level. I recommend 6 months to a year. Christian's a little bit more riskier than that. He's a nasty bastard. He's going over 3 months. Um, but from that point forward, you want to be opening up like either a traditional Roth IRA or you want to be opening up a not Roth IRA, traditional IRA or Roth RNA. The Roth is the one that is taxed now, and then later when you take it out, you don't have to pay any taxes on it, but it has a smaller amount that you could put in it. And then you have your traditional IRA, which is more, it'll be taxed when you take it out. And then you have your brokerage account, which you can use to individually buy stocks, real estate trust investment. Those are actually pretty good too. We'll get into that later one day. And then you have your ETFs, which we highly recommend people do. Don't be crazy like me and Christian. We all, like I said, we are cursed by thinking we're the smartest people in every room. Keep it simple, stupid is what we should adopt. But that's not us. But you can buy individual stocks. You could buy ETFs, which is exchange traded funds, or you could just allocate your money straight to mutual funds. And have somebody else do it for you. If you're just straight up fucking lazy and you're like, Mercer, what do I need to do? I'm gonna tell you, just get a mutual fund and save yourself the problem, save yourself the headache if you want nothing to do and just make money. If you want to like have to like put money in and buy stuff and do all that, then you can do ETFs.
Yeah, I'm a little different. I always recommend the middle ground. Whenever people ask me like, yo, what car should I get? Get the middle ground.
Well, most people are stupid and lazy.
Get the middle ground.
People are stupid.
But yeah, but it's like Ali said, like there's not a lot of barrier entry to just buying BT or just buying VO.
Like I said, people are stupid.
Index fund is diversified. Try index funds. You might like them.
I'm saying, but if you are stupid, and I'm not saying you're fucking stupid, but you're lazy. You're lazy ass. Okay, it's better to invest than to not invest. So just get the mutual funds. I mean, let me check and see how much is Vanguard. Let me see how much expense.
0.04%. And also, it's a domestic.
Ali, what made you choose index over mutual? I guess that's a good
because when I was learning about this from my coworker who introduced me to it, I mean, index funds are the ones that just beat everyone, but like not everyone, like 95% without any effort. So that's why I decided to.
And was there an appeal that it was an algorithm and it was kind of like automated almost? Was there?
Yeah, in the sense that you're cutting out the middleman, right? Like if you pay someone who's an active investor, if you pay for a mutual fund that's actively managed, the people who are actively managing it are taking a cut of the money, and you're hoping that they make such better decisions than the market average that, it makes up for it. But I mean, no one can predict the market. I can't emphasize that enough. No one can predict the market. That's why index funds beat all the actively managed funds by people who spend their careers studying this stuff.
Look at that on the left, Mercy. Right, out of 10,000 with a 0.5 expense ratio.
This is mutual fund. This is mutual fund.
$50. That's a lot, bro.
$50 is a lot?
$50 a year on 10,000? What about when you have $1 million?
So, bro, $50?
Bro, that's a lot, bro.
$50
on 10,000, but it's not gonna be 10,000. It's gonna be 100,000, and then fucking $1 million, and then what I mean.
All right, so multiply that by, if that's 100,000, that's only $500 for absolutely doing no work at all. Are you fucking kidding me, Christian?
I think index funds are superior, bro.
I'm just saying that's pretty fucking easy, bro. If you just don't want nothing to do with it and you just want to have money whenever you retire, you don't give a shit. Bro, $50 on $10,000. What are you talking about, boy? We go to the fucking bar and spend that in a fucking night. What are you talking about?
That's not the point. The point is that it builds with your account. It's $50.
Yeah, but that's $50 on 10,000. If that was 100,000, it's only 500. Bro, if you sweating $500 in a year, you got
Ali, what do you think about that?
You got a problem. You got a problem.
What do you think about that?
What's the expense ratio again?
Huh? 0.50.
0.50. That's pretty steep, actually. I mean,
yeah, I think it's steep.
I mean,
it's like, because you gotta remember, VTSAX is only 0.04. Like 0.5 is more than 10 times that. And like,
that's what I'm saying.
Yeah, but that's if motherfucker.
I was trying to explain earlier.
You're going to keep up with the ETFs. That's if you're going to keep doing it.
But bro, you don't keep up with them. You just keep buying them. You don't keep up with them. You just keep buying them.
Some people just want to put a button and hit automatic and be done. I'm just giving people the options.
You could do that with the index fund.
I'm just giving them the options.
You can automate your investing and buy index fund automatically. You know that, right?
I'm just giving people the options. I wouldn't sweat $50. I'm gonna be honest with you. I wouldn't sweat $50. If I wanted to be a brainless moron and not be interested in it, I would not be sweating $50 fucking dollars.
It's a bit more deceptive because, all right, so that's a 0.5. Okay, what if it's $200? It still doesn't seem like that much, right? But now at that point, now you've gone up to a 2% expense ratio. And I was trying to explain this earlier. Like, if you go ahead and you, over the course of 25 years, you invest in some principal amount, even though you're fronting 100% of the risk because it's 100% of your money, if you have a 2% expense ratio after 25 years, the financial institution ends up keeping 66% of that money and you only get 33%. The expense ratio it's a compound interest
Yeah.
that you
Right.
pay.
And that's
So I
the thing you're
mean,
missing too. You're missing on the compounding of the money that you're paying. So the opportunity cost of it is way greater than $50. It's $50 the first year, but that $50 could have compounded to who knows? Because you know what I mean?
I mean, over
So
time. I'm just saying, if you are fucking lazy, hey, bro, it's better than if you lazy. I just got to give people the options, bro. I just got to give people
that's
the
fine.
options. If
That's
you
fine. You can
lazy, hey, it is what it is. But if you want to you want to be more active with it, you have to go that route. You'll save more money. Hey, but I got to give people the options, Christian.
that's true. That's
yeah,
true. I
that's
appreciate that.
true. But
There's
there's also one.
a lot of people that have used mutual funds. Like that's probably the easiest vehicle that people have used throughout time. Um,
Yeah, I appreciate that. I guess I'll just say, you know, like
it's a way for people to feel more
index.
safer.
Yeah, yeah. Like
They feel more safer. Like I said, absolutely. You talk about zero work here. You just putting money
oh
in the
yeah, yeah.
bank account
That's fine.
and you putting it in accredited people's hands, and then you just forgetting about it. Yeah, they're gonna take a little bit because they're doing the work.
Yeah,
Okay, could you
yeah.
be like us and read a couple things and cut that the amount of money that you're losing? Yes, but I gotta give people the fucking options here.
Yeah, that's fine. I guess I'll just say if you're not gonna invest unless it's a mutual fund, then obviously pick the mutual fund. The worst thing you could do is not
Nah,
invest.
yeah.
You know what I mean? So if you feel safer with a human managing your account as opposed to an algorithm in the index fund, then go ahead and pick the mutual fund. Just invest. Like, don't stay on the sidelines. Because, like Ali said, it's like you're guaranteed to get screwed by inflation at that point. Yeah.
And I will say though, if you're worried about an algorithm managing your funds and you want to pay a middleman instead to supposedly do better, again, just read the simple path to wealth and look at the numbers. Like you're beating 95 or 97% of actively managed funds with an index fund. The algorithm ends up beating them over a long course of time, over decades.
Yeah.
I mean, you just got to give people the options, man. The options.
Yeah.
So
Oh, there's one downside about VTSAX though. You need to have at least $3,000 minimum investment to like start investing in it. It's really frustrating because I have some friends who are not very well off financially, and like investing is a way you can like sort of build up.
you
But
just buy
like just
Voo.
that,
You just buy Voo.
huh?
Just
Oh
buy
yeah,
Voo.
yeah. So in that case, if there's no minimum investment there, then that's an option.
Well, I would say, like I said in the first video, if you don't have $5,000, you're in crisis mode. Now, I recommend instead of investing, if you have less than 3,000, put it in a SoFi account at 4.6% guaranteed
Mm-hmm.
until you have 5,000. That 5,000 is going to be your emergency fund, essentially, is what I'm saying. And then after that, you can decide if you want to put the 3K to initiate the investment in VTSAX, or if you don't want the limit, you could start with VOO.
Mm-hmm.
But my point is build a savings account first, like the emergency fund. You know what I mean?
Yeah,
Because
I agree with that.
you don't want to pull money from your investments to pay for your life in case something happens. Like you want to have a good
True.
cushion. Yeah.
That is true. Oh
But
yeah,
like I
one other
said,
thing.
all
Yeah.
of us are, all three of us are extremely disciplined people. So this shit's very easy for us. If it's harder for you, you may have to go different alternative routes. Like this is like a no brain for us. It's like going to the gym is like a no brainer. Okay. This is like a
Yeah.
no.
Yeah,
Like I said,
it only took us like 6 to 12 months to start investing after working. A lot of people it takes a lot longer unless they have a parent or somebody who gets them started. Like literally we picked it up like
I had to convince a INFP, and she's actually doing way better than me, which is
Don't
sad.
even.
All of her ideas come from me, which is crazy. It's fucking crazy. All of her ideas come from me, and she's doing better than me. She's just a lot safer. Um, that motherfucker. I don't know about this versus shut up. I'm like, yo, we're buying this stock. No, I don't know about this.
We covered a lot of stuff,
Yeah,
like
we
all the
did.
basics. Everybody could get started with this video, similar to how everybody could get started saving with the first video. Like
Yeah, and I'm
these
not cutting
two
none of that shit.
videos could literally change your life. Like I know it sounds crazy, but
It's true.
like if you follow these two videos, like it sounds super simple, but no one does it. That's why they don't take advantage of these things, you know?
That's why we're in
This
the position we're in. We're in very good positions.
This is another thing I'd like to add, just as I guess further motivation or whatever. I was saying how it takes 23 years for the money in your bank account to get cut in half, assuming inflation is 3%. You can
More than that lately.
huh?
See, it's been more than that lately.
Yeah, true.
It's probably
You can conservatively estimate that the market's going to grow 7% a year on average. It's actually usually more than that. And the net difference there is 4% growth. So if you were to just put your money in an index fund instead of a bank account, so you put your money in a bank account, your $100 becomes $50 basically in 23 years. With an index fund, your $100 becomes $200 in 17 years. So you can either double your money in 17 years or get your money cut in half in 23. And when you think about it like that, it's like, well, why the fuck wouldn't you want to do that?
Right.
So, yeah.
It's a no brainer, but we also have to have a little bit of empathy. Like, you know, first of all, we're all college educated. We're all from the STEM field. Like, we all study statistics. Like, we have an educational advantage that I think sometimes we don't take into account. Like, a lot of people can't even do like simple algebra. Like, and I'm being dead ass. I'm being dead ass honest. Like, I'm not even being insulting. Like, a lot of people can't do regular college algebra. Like I'm being honest. So like obviously to us it's gonna make a lot more sense when we look at the numbers and we kind of see like, oh, okay, no brainer, you know. But like to other people, it seems like some magic, like voodoo or something that is a scam and it's gonna take their money, you know. So
Yeah. Yeah.
Yeah. Well, guys, this has been a fun one. We went a little extra long and had some fun here. But comment below if this helps you, and Kevin, I hope this helps you. This is a beginner. We're not going to anything like intrinsic value calculations or price per earnings and things like that with the individual stocks. That's me and Christian's kind of thing there. But I'm gonna tell you straight up, I got a different respect after getting slapped around a little bit, you know. I'm probably just gonna take a couple years of just buying index funds or Berkshire Hathaway.
Mhm. I
So
You know
think
what the best go
you
on.
know, one thing I could say is like we swung for the fences in a lot of ways in our 20s. But like I was telling Ali the other day, like if you're gonna do that, you kind of have to do it young because like you're not gonna do it when you have kids and a wife, and you know you're not gonna risk to that level because you got stuff to take care of, you know. So hey, it is what it is, you know. And we learned a lot. Like if
learned a
we
lot.
didn't go through all that, we wouldn't be making this video for all these people. So
Boy, if we wouldn't have went through that, I might be slapping people. You know, I can get real nasty, bro. People don't understand it. I am.
no, but
Well, if life wouldn't slap me so much, I'd be like Donald Trump. I'd
and we're
be
making it
like,
sound really bad, but we're doing really well. And honestly, like we're doing fine, bro. We're
Yeah.
ahead of a lot of people. Let me
I
just say
don't know
that.
anybody. I mean, you remember that one time we were at the wing stop, and the guy was in there was bragging about money, and then I just like pulled up my account, and he was like, "Who are you guys?" It's like, you broke motherfucker.
Oh, mercy,
You remember that
mercy.
shit?
I do remember that. I
That shit
do
was
remember.
funny as fuck, man. That dude was like, "Who are you guys?" Like, bro, hey, we should have stepped on your back, peasant. Lay down and lick our boots. Uh,
Hey,
but
hey, Ali could be saying that to everybody, but he don't.
I know he's a fucking INTP, bro. Humble motherfucker. Fuck you. We don't care.
I don't have the physical imposing presence to just go up to someone like Mercer and be like, I'm gonna step on your back, peasant. Next thing you know, my back is broken.
Hey, Chris, you remember that dude's face, bro? He was like shocked.
Yeah, he was. He's like, who are you guys? Like,
You know, back in the day, Christian, my brother, and Jared, we used to have this thing. Like when you like destroy somebody, it was like we unzipping the zipper. And like Jared is so ridiculous. Like he would just like randomly
like,
start playing with the zipper.
That's so
Oh
true.
my God, you're fucking idiots, man. You're fucking idiots. Like,
Man.
the zipper's getting unzipped. Like,
Oh, he'd be like, oh.
Oh my God. But hey, we'll get into those story times one day. We'll go down the story time. We got a lot of stories with Ali. We've known Ali for a very long time.
Huh?
So we've known you for a very long time.
Oh, yeah.
Especially me. We lived together for years. So
all right, guys, we're out of here.
Good times.
Take it easy, guys.